In this presentation, we will take a look at an example problem of a capital asset acquired under a lease agreement. We're going to look at the capital project fund and the government-wide activities. We'll start off with the government-wide activities because that will be on an accrual basis as opposed to the capital project fund, which will be on the modified accrual basis. The scenario is that we have a lease with a contractor to build a building, which we will then occupy. The fair market value of the building will be the $19 million. The initial payment, $1,333,661. Annual payment of same amount for 29 years. So we're going to make the same payment for 29 years under the lease agreement. And then the interest rate is going to be 9%. So if we think about the government-wide type of activities, we are in essence going to put this on there as we would a capital type of lease. We're going to put the building on the books at this point in time. So the transaction will look like this, the financial transaction. The building going on the books, we're going to put the building on the books at the fair market value. We're going to have the cash, the initial payment that we will be making. Of course, cash will be decreasing. The difference then going to the lease obligation payable. Note that what we have here is then we're going to capitalize this, basically the lease, the building at this point in time. And we are going to put on the books the payable, representing the long-term payable as if we were purchasing the building at this point in time. This will look familiar for a capital lease type of activity in terms of the normal accrual basis. If we were to record this, then we're going to say that cash is going to go down, so cash decreases. And then we have the building is going to increase, so of course the building goes on the books. And then the lease obligation is going to be the difference, and that's going to be the liability account, the liability then increasing in the credit direction. So we have our trial balance here, assets in green, liabilities in orange. The net position would be the equity, similar to the equity for a for-profit organization. And then the revenues, the only thing representing what would be the income statement type account, the temporary type accounts. And this would be the activity should look somewhat familiar as a capital lease that we would then record. Now we want to think about what is this going to look like on the capital project fund, on the fund side of things. We're going to record this in the capital projects fund. We know that the cash will be much the same. We can record the cash. Cash is cash. The building, however, is not going to go on the books at the $19 million because we don't record the building long-term assets in the capital project fund, it being on the modified accrual, only having current assets. So we're going to have to do something else with the building. And the lease obligation payable, also something that we're not going to have on the books because that's pretty much a long-term liability. We don't have long-term liabilities on the modified accrual governmental fund of the capital project fund. So we're going to have to do something else with the lease obligation payable. So the journal entry will look like this. Rather than debiting the building, we're going to debit expenditures, which is like the expense type of account. Cash then decreasing. The other side going into other financing sources. That's going to be the same kind of account or the same number that we use to record to the payable account when we looked at the accrual basis on the government-wide type of activity. So you can see that these two items are in essence going to show the flow, and they're going to net each other out in the temporary section, what would be similar to the income statement type section, what would net out and similar to net income in a for-profit organization. If we post this, then we can see, of course, the cash is still going down. Cash is doing what cash does. And then the expenditure is going to be increasing. And then we have the other financing sources, and that's going to be kind of like revenue, doing the same thing or acting in the same fashion as revenue, increasing in the credit balance. These two then, in essence, netting out when we think about the net of what would be similar to the income statement in a for-profit type of organization.